Hi, everyone, and welcome to today's video. I want to share with you a thought process I have quite often as a professional in the mortgage business. Someone that gets to see, basically how homes appreciate, how interest rates have fluctuated over the past 10 years. I've been in banking since I was 17. And so with all of these insights, I think it's really a good idea to be able to share this with you guys and let you see what it really looks like when you actually take the time and someone explains how things work long term. And so all of this is in reference to why I absolutely believe for the majority of cases, like 98% of the times, it is significantly better to be a homeowner than someone that rents. And so, one of the goals I have is to help people figure out ways to strategize how that can be something that they achieve, whether it's by themselves as an individual, with a group of partners, whether they do it as a family, whatever the case is. I'm going to share some really important stuff today. So that way you can take a look at it for yourselves and make a determination about whether this makes sense for you. And as mentioned earlier, I believe it does. So what we're going to do is we're going to start off with sharing my screen, and we're going to talk about the difference in renting versus owning. So give me just 1 second here. I believe you should be able to see my screen as of this moment. So what I've done is I've created a little bit of a calculator. This is a system I use, MBS Highway. It's buy versus rent comparison, and we're doing it for San Jose, which is the city that I live in. We're gonna look at a property of 1.2 million. Our tax rate in San Jose is right around 1.25. Homeowners insurance is 150 bucks. Repairs, we're just gonna say about $150 a month, just for gardening, maintenance, anything of that sort. And in the future, if we sell this, it's going to be around 6%. So our loan is 1,080,000, and that's basically a 10% down payment, 30-year term. And basically what you're going to see here is this is a conventional loan fixed at 7%. And because you didn't come in with 20%, or not you per se, in this example, the person didn't come with 20%, they only came with 10, you're going to have mortgage insurance as well. Closing costs is estimated to be just right around 2%. It's a little bit less in most cases, but that's my estimate. So all of this information is just to build up that you're going to have the property for about 10 years. And what's the difference in those 10 years had you continue to rent your property, or rent a home, excuse me, versus own it? And so we're just going to look here, a little bit more information. We're in California, Santa Clara County. Our historical appreciation has been 6.6%. but it's forecasted to be 7.84. So you'll notice it's increasing. And then when you sell it, there's taxes. This is the rate that you might be taxed, married, file, and joint. So anyhow, lots of information just to set you guys up to get to a point where you could understand these numbers that I'm going to show you now. So your monthly principal and interest when you have a loan that's 1,080,000, and we're assuming a 7% interest rate. The great thing is the likelihood is that rates will go down, but even if they don't, then maybe you would be glad that you bought ones at 7% if in the future it goes to 8 or 9. I'm an advocate of believing that the rates would go down, and I do believe that would actually occur before the end of this year. We're in April right now, the 4th of 2023, and my prediction is that rates will go down by the back half of this year. So property taxes on a monthly basis can be $1,814. Repairs, as we talked about, is $150. Total monthly expense is going to be $9,149. That's what it costs today to be a homeowner. Now, if you were renting a property, probably a 3-bedroom, 2-bath, you can anticipate your mortgage, or excuse me, your rent would be right around $5,000. So that's the difference. You got 9,000 versus the 5,000. So in 10 years, the rent prices, you'll notice, are going to increase just a little bit. And so you'll notice that they're increasing 3.438% over time. So this dark blue line is the continuation of your mortgage payment. It's going to be pretty stagnant here. It does go up a tiny bit because there can be fluctuations in the property tax. And you'll notice here, your rent slowly goes up as well. So in those 10 years, the appreciation gain is basically the amount that your house started off, your purchase price, versus how it's gone up over time. So we're looking at an appreciation rate of 7.84 on the $1.2 million purchase. After 10 years at 7.84, the value is now going to be $2,552,000. So it is actually doubled in 10 years. And this is by the purchase price, not how much you've invested into it on a monthly basis. Now, amortization gain is basically the difference that when you make your payment, that a portion of it goes to reduce the balance. That's amortization. So in those 10 years, we will reduce it from the 1,080,000 down to 926,774. Now, yours might even be lower if you choose to pay at a more accelerated rate, because there's no prepayment penalty on most conventional loans. So this is something that you could very easily do if you decided to. You don't have to, but you could. We'll continue to go down here. The cost to sell, assuming on the future value at 6%, it's going to cost 153,000. One other thing to be aware of is that there's a tax benefit here. You're going to have a deduction for the interest and the property taxes that you guys have paid on a monthly basis going forward. So a lot of information. Here's where it gets really simple for you. What you'll notice is the initial cost difference is that you're paying a little bit more per month because you're going from the 5,000 to 9,000, right? So that's a big difference up front, right? The cash flow is the difference. The closing costs, they're adding it in there, the 18,500. So the 411 is the cash flow month over month for those 10 years. And then the cost to sell is this 153. But if you were to take these costs away from the appreciation gain, so once again, the value of the property is increased. If you add back in the amortization gain, which is the difference of your starting loan, and as you're chipping away at it month over month, and then also the tax benefits, and you basically compare those one to the other, over 10 years, you're going to have a difference of just shy of $1 million. This is massive. This is how people that are homeowners basically have an exponentially larger, I wouldn't say income, but they just have more assets, more value, more cash flow, more money in their name at the end of the day. What's really interesting is that this is only after 10 years. What if we were to magnify that by 15 years? Tab that over. Now you've gone from just shy of $1 million. And in the next 5 years, by adding 5 years, you now have gone over to $2 million net gain by buying a house. Now, I recognize that we are in a very expensive place in comparison to the rest of the United States, and therefore maybe having a payment that's like $9,000 would be really challenging for a lot of folks. I completely understand that. One of the things that you could do, I'm not saying that you should, but I'm saying one of the things that you could do is you could go with an interest-only loan. So instead of having the payment at the $7,185 for principal and interest, you could do interest only and have a payment of $6,300. So that's almost $1,000 savings. So that's one option. I'm not saying that I would suggest it. I'm just giving you options that are available if you needed to do it. One other thing to take into account is this chart doesn't show how the rent is going to raise over the years. But what I did here is I took a look here. I plugged into an appreciation calculator that should be accurate, but maybe it's a tiny bit off. Furthermore, I know that the rate of increase for rents is closer to 5%. So that's why we use this. You've used this, excuse me. Starting rent is $49.29. We're going to assume that's going to go up 5%. And what you'll notice is that within 12 years and 9 months, it actually goes up to where the current mortgage would be, the $9,181. Now matches the $9,149. It's actually a tiny bit higher. So if you had decided, hey, I can't get to this number, it doesn't make sense for me, I understand. But here, believe a lot of folks are missing is that within those next 12 years, while you haven't owned the property and you haven't made the $1 million down here, where's the term? 15 years? You haven't made the 2 million or whatnot. In the 12, almost 13 years, your rent has now caught up to what your mortgage would have been. But guess what? You're only going to have that mortgage for 30 years if you don't refinance and you keep it the exact same. So that means that your rent is now going to exceed your mortgage payment going forward for the next 27 years and 3 months. But guess what? Your rent doesn't expire after you've lived in a home for 30 years. It keeps going onwards. So if you can imagine this, if you had been in the property versus 12 years, maybe you stay there for 30 years and your mortgage would have been paid off by this point in time. So by the time that your mortgage is paid off, and it would have been $9,000 the entire time, your final rent payment 30 years from now is going to be around $21,000. This is absolutely insane. Even if it doesn't increase by 5%, let's say it only appreciates by 2%, you're still getting pretty close to the value there at 30 years. But guess what? This is going to go on indefinitely. I don't know where 2% would be. I mean, honestly, it's going to be like 3 to 5. I mean, it just makes sense, you guys. Homeownership, if you guys can afford it, I would highly suggest considering becoming a homeowner. Now, there are some instances, I'll make another video as far as when maybe being a homeowner may not make sense for you, some things to be cautious about, things to be, just aware of. If you guys have any thoughts, concerns, or questions, please don't hesitate. Respond to this video, reach out to me. I would love to help you explore these options and really understand why I believe homeownership is a much better deal long-term than renting. Take care.